Just as you're joining us today, welcome. We're on our new format here. We've only had one of these before, which is our Xact Xpress format. So we're in these sort of quick format webinars. We're trying to really cover a single, usually a fairly narrow topic. And we're going to try and hit it pretty quick. We have our longer form webinars, which are our masterclass series, where we can take a broader kind of look at things, and we can go a little bit deeper on that subject matter as well. But with this format, we're trying to get it in and out in half an hour. Everyone is busy, and so this is an opportunity, I think, just to get some quick information on a subject that we think is important. And today, that subject is equipment finance. We've got Gus here as a late replacement. I think you were going to sort of come along anyway, Gus, but
Yes.
unfortunately, if anyone was turning up to see Mo today, he has taken sick. And so we have very thankfully Gus, who's a real expert in this space as well, has joined us from NAB. You certainly say g'day in the chat, everyone, if you'd like to, just so we know that's working. G'day, Megan. Good to see you. So Gus is going to be the main content presenter today. We also have Josh, who's our partner in our compliance division, one of our partners in our compliance division. So Josh is here as well, and is just going to drop in some bits and pieces as we go. Hopefully a bit of banter as well. But I'm just going to share my screen now, and we're going to kick off, guys. So just some housekeeping. As I said, this is equipment finance is the topic today. Questions, drop them into the chat as we go. We're going to try and answer them at the end, though, because of this format. We think we can, really push through. It's only half an hour, and then once we come up for air at the end, we'll try and answer anything that's in the chat there. We might sort of, respond to some of them in the chat as well. Anything complex, though, we're going to take that offline afterwards. We kind of don't want to get too bogged down in this, so we can kind of keep the content moving. Recording, as always, we will send the recording of this webinar after the show, and any resources that we may have mentioned along the way as well. We're going to offer at the end as well an opportunity to book a one-on-one with either Gus or someone in the team at NAB, or with anyone from our team at Xact. So we'll offer that at the end. Just very quickly, this is the quickest version I've ever done of this. At Xact Accounting, we provide 3 different services. We provide bookkeeping. So this is for when you really want someone who's an expert in construction accounting, looking after your books, and you don't want to necessarily hire that in-house and have all the headache of running another staff member, et cetera, and hoping that they know what they're doing. You can come to us as experts at a fraction of the cost of having someone full-time employed. Compliance is Josh's team, and this is all about tax and structuring and also they look after things like home warranty and the various state-based regimes around keeping your building construction licensing intact. And then finally, our CFO advisory team. This is the team that looks after strategic and commercial advice. If you're running a business in building and construction, it's hard to really know where you're heading sometimes. These guys will help on things like margin improvement, even how to build out a team, when to hire, all those sorts of things. They're experienced CFOs, and they've seen a lot of action over the years. So they bring all of that experience to bear for you on a fractional basis. So rather than having to employ a $350,000 CFO in-house, you get to have one as a sort of part-time resource that's plugged into your business. So that's us. I will just do a quick disclaimer. We're going to go over some information today. It's really just general information. If you do make any decisions, please make sure that you consult your own professionals before you do so. Hopefully, you do get some good information out of today. But this is just we're going to refer to some specific circumstances. They may not be the same as yours, so please take advice before you make any decisions. I'll stop sharing and take a breath and hand over to you, Gus, to get into the meat of this presentation today, which is about equipment finance, mate.
Thank you very much, mate. So, I have committed to having a quick session today to keep in line with the short form content that we're doing. Just a quick background. So myself, I'm Augustine Tassano. I'm one of the senior business banking managers at the National Australia Bank. My specialty is banking diversified businesses. So that's anybody that makes something, builds something, and sells something, whether it's in import or export. Outside of myself, so I'm a relationship manager, we have the specialists. So think of myself in the middle of a wheel. From myself, there's different spokes that come out. One of those spokes is our asset finance team. And Mo Kadua, who's my equipment finance specialist, who's unfortunately unwell today, is one of my colleagues that supports my customers. So I've jumped in his loop, but it just really shows that the business bankers that are your key contact at the bank, we do have a pretty good knowledge across all our products that we offer to our customers. The specialists are able to jump in and help us out when we talk about specific types of assets. So today, with a focus on construction, which is something that's very close to my heart, we'll be talking about all the equipment that we need to help you guys buy, refinance, and purchase to build those dwellings or commercial buildings for your customers. So I'm talking about bobcats, we're talking about access equipment, whether it's a spider lift to get down a really narrow job site, or maybe it's a telehandler to complete some work in lieu of scaffolding, or maybe it's some digging equipment like a bobcat or a backhoe. So these are the type of assets that we're talking about. It does span across a whole heap of different industries as well. So the main three things I want to talk about today, just to give you an understanding on what support you can get from a funding perspective, is asset finance is not only used to buy equipment instead of the business having to inject the whole heap of capital. It can also be used to help you with maintaining your cash flow cycles and understanding on whether you're aligning the repayments to potentially a progress payment. You can also use asset finance to free up cash flow and potentially look for some tax deductions as well, which is one of the reasons why Phil and Josh mentioned at the start of the presentation that it's always important that before you make these kind of purchases, is that you do consult your tax professionals or other professionals to make sure it's the right fit for your business. There are a couple of different ways that customers I've helped over the past have bought equipment. It might be new equipment, which is directly from a supplier. So if we're talking a crane, you might be getting a 50-ton DMAG, or maybe some 15-ton franners directly from Liba. So that would be a brand new asset, and there might be some lead time on that product. Or it might be that you've seen a couple of assets come up at Pickles or Slattery's, one of the auction houses, that's in still pretty good nick, and it's fit for purpose for your job, and you might be buying it from a second-hand reseller. Or it could be someone that you've been cross-hiring from. So it might be ABC Proprietary Limited, and they actually want to offload one of their assets because they're no longer doing that kind of work. That would be a private sale, and that's also something we can help you with. If I jump through, what is equipment finance? How does it operate? It's a loan product, but it's not the same as a home loan. It's not the same as a standard business loan. So the security for this type of loan is the bank actually registering a charge over the asset itself. So it's not a funding situation where we need to take equity from one of your properties, or we need to rely on tying in a mortgage. It's something that's secured solely by the asset. Now, the reason why we're able to do that is the funding term is significantly different. So if you're talking about a home loan or a business loan, the repayment might be over 30 years for a home loan, or it could be over maybe 15 for a business loan or a commercial property. With asset finance, you typically have a more aggressive repayment cycle, because the asset that you're buying actually deteriorates from the use. So the useful life is significantly less. Typically, your asset finance loans are anywhere from sort of 1, 3, 5-year terms. And that's where we would take the entire loan balance, have principal payments every month, And by the end of the loan term, it could be either refinanced with a balloon, which I'll explain in a moment, or it could be paid off to zero, which builds equity in your business. The product itself, when it's applied for and approved, is a fixed rate product. So it gives you certainty of cash flow. As the RBA and the cash rate moves, you'll know that your loan commitments for this specific asset or potentially the fleet of assets is fixed. So it allows you to work with your accounting team, or maybe it's the CFO advisory team, to understand, okay, well, for this new job, we're going to need, one spider lift, we're going to need a couple of backhoes for the digging, and you can account for that additional cost as a fixed cost in your cash flow cycle. And it allows you to effectively price the job to make sure that you're not going to be out of pocket for that specific equipment you need to complete the job for the customer. The other part of asset finance, which is really cool, is we're able to structure the repayments either in advance. So if you've got some accounting or tax positions that you're looking to mitigate or manage with your accounting professional, you could actually pay a full year's interest upfront, and that might help from a tax minimization strategy. Or typically the payment's made in arrears, similar to any loan. It accrues interest with every day in the month, and then it's charged at the end of the month. So there's 2 cycles that we do there. And we also have the ability to assist you with funding the full price of the asset. So that's the asset cost plus the GST. Now, the asset itself might have a GST credit that's applicable. And our preference, if we are funding the full loan amount, would be that once you've lodged that BAS and you've received the ITC credit back, you can actually pay that as a lump sum directly onto the loan as well. And we can structure the product that way as well. I mentioned at the start, there's a whole heap of assets that we can fund. These are a couple of ones on the screen here. So your general motor vehicles, so that might be for your tradespeople to get around to job sites. It might be the trailers on the back of the utes that are getting pulled that have all the equipment. We've got access equipment. We've got earth moving. We do stuff in the agri space as well. Technology is also one that we fund, and then fixtures and fittings. Depending on the asset type, the same as any sort of lending application, our loan term and the rate will differ based on the assets. And that's just based on the risk of if the assets needed to be sold in the secondary market, what the recoup would be. So as you guys kind of know, it's a bit of an old sort of anecdotal tale, but the second you buy a vehicle, you drive it out of the dealership, it already starts to depreciate. So similar thing with these assets here. We fund based on the useful life of the asset, which you can talk to your accountant about. The ATO have a general guideline on what a useful life of different assets are. But if I was looking to support yourselves in getting some funding, if we're buying specific assets for a job and it's not going to be used across all our job sites, we'd be having a conversation about, well, let's make sure that the financing for this specific asset, might be a specialized asset, aligns to the job timeline. So that way, after the job's finished, you're not left with this chunky loan repayment without another job to use the asset on. Structures are really important to talk about, and it's something that it's always good to think about upfront as well. So most of these loans, if you took a simple cycle, you would have a loan repayment for 12 months. You look at the whole payment, and then it would get chopped up into the same monthly payment with the principal, which is a payment of the loan down, and the interest each month. So divide by 12. That's typically how asset finance moves across for most of the industries. For construction, and that's where our specialty comes in understanding your cash flow cycle, whether we've got the rainy season that we've just gone through, where we had a heap of rain at the start of the year and that's delayed your ability to get on site, or in some cases for my own customers, whether I've got some civil contractors and just some of my general builders that were sort of doing footings, they had to redig the footings 3 or 4 times with the amount of rain that we had. So there's cash flow implications that come to that. And then also on the flip side, you might have a shutdown period. So coming into end of the calendar year in December, I know it gets really busy as all your homeowners and your clients, they want to have the house ready for Christmas. They want to move in, but then there's maybe a little bit of a lull period over December, January, and things don't start to kick back up until February. If we can have that conversation up front and you are talking with your accounting partner or your bookkeeper to understand what the cash flow cycle is, we actually have the ability in our NAB product, which is something that's unique to our team, to structure your repayments to have, repayment holidays or no repayment during that period. So what that means is If we take a 12-month calendar approach and you normally divide by 12, we might say, okay, well, December, January, and February, those 3 months are a little bit difficult on cash flow. So what we're going to do is we're actually going to structure this loan for this specific asset over 9 payments. And that's going to be made from January to November. And you still pay the same outcome. The only difference is the cash flow for those 9 months will be significantly higher to account for the repayment you're not paying over December, January, and February. The reason for that is you're not going to be making money over those periods. You might not be able to provide an invoice and get a progress claim funded. So if we can help you with itemizing those costs to a period of the year where money is coming in regularly, it'll allow you to have a little bit of more rest over those periods and not lose sleep over having to pay out these commitments whilst your jobs aren't generating you any revenue. The other part of it is as well is the alignment of the payments up front. So you might be needing to, if we talk about the example where you're buying brand new equipment, for example, there might be a significant lead time. So you might have to place an order on the product, put a deposit down until the asset's actually ready for collection. So the main thing we need to clarify, asset finance under these products is only able to be used when an asset is fully built and commissioned and ready for pickup. So the product itself can't be used for progress payments. So if you're building a specific asset or the client, the customer you're buying the asset from needs a deposit up front, we need the business to actually contribute that deposit. There is no problem with our funding arrangement to be reimbursing you for that deposit once the asset's ready for collection. So the asset might cost $100,000 and they need you to put down a 20% deposit. You'd make that payment, you'd keep the receipt to show it's been paid. The invoice that we would get from the dealer or whomever you're buying it from would show $100,000, a balance due of 80 because you paid a 20% deposit. You'd provide that to your business banker. We'd work with the asset finance team to give you a quote. The quote would be for the full asset cost, depending on what our conversations are, which is $100,000. And on the day that it's ready for collection, we would make a payment of $80,000 under the loan directly to the dealer. That would clear the balance with that dealership. So they're ready to release the asset. And the $20,000, which is your 20% deposit, would be reimbursed to your business account. Or if your preference was to be always putting down a deposit, so you build equity in the asset from day one, we would just be paying an $80,000 deposit straight to the dealership, and you've already got that asset with some equity built in. The other part of our funding that we haven't really touched on yet is a balloon payment. A balloon payment is a percentage of the facility, so the loan, if we talk about that $100,000, where the useful life is maybe a little bit longer. So we're talking potentially a crane, maybe some specialized access equipment that the ATO's usable life might be 10 or 15 years. As I mentioned at the start of our seminar today, typically asset finance is 1 to 5 years. There are some special niches where we can go out to 7, but from a cost perspective, 1 to 5 is normally where we sit. So a balloon essentially allows you to allocate a portion of the original purchase price as a lump sum. So if you had a loan for $500,000 and you wanted to have a 20% balloon, NAB would fund you a loan for $500,000, but you'd only be making repayments on the amount less the balloon. So 20% would be $100,000. So your monthly payment would be calculated on getting that $400,000 to zero within your contracted loan agreement. And then the last day, that last payment would be $100,000. It gives you the option to either go out and sell that asset and maybe recoup the 100 and pay the loan off, or you could engage us early and say, look, Augustine, this asset's still pretty new. We actually have a couple more jobs that we're going to use it for. We'd like to take that $100,000 remaining lump sum and refinance that over another 24-month term, essentially giving you 7 years of funding, the original 5 and an additional 2. But the benefit that you've received is a cash flow reduction because that initial 5 years, you've only been paying monthly repayments and interest on the lower amount. So there's some specific assets that we can do that on. The other part, we'll jump into some scenarios here just quickly. So this scenario here is specific to an engineering business. But essentially what the strategy that this customer employed with our team was they took on some contracts and they were in a position where they were either renting the asset already, or based on the work that they were doing, they've done some cost analysis with their accounting team, looked at the cash flow, and they've realized that if they were to purchase a brand new machine, they would be able to do greater output, generate more revenue, and do it a lot quicker with less rework. And that's something that is typical across the industry. So the beauty of asset finance, it's that most of the machines that you'll be purchasing are income producing. You're not purchasing, an excavator so it looks pretty in the office and it just sits there and it's something nice to look at. You're definitely not purchasing it to live in like a property. You're buying it because it's going to be able to go out on site, and instead of having to have 5 laborers dig the footings or dig a trench for the plumbers, waste plumbing with shovels, you might be able to get it done in a day with a backhoe just doing the whole thing. So we actually are able to look at projections. You can give us an understanding of what you think your cost savings will be. So the benefit of that is we're able to take a really common sense approach and look at your financials. So today, Josh and his team might do up the financials and the business is operating at an X dollar profit based on, the year-to-date summary. But the conversation we're having is, well, look, Augustine, if we buy this specific asset, the backhoe or the bobcat or whichever, we're actually going to be able to reduce our wages on this job. We don't actually need to have 2 laborers for 30 hours a week to get it done. We can actually reduce it down to 1 laborer. So that cost savings, we can rationalize that as additional income that we can look from our servicing perspective to add on to the approval for that loan. So that's the benefit of looking at asset finance. You also can take out any cross hire. So in your businesses at the moment, you might be cross hiring some assets from other clients, or you might be going out to market, especially on these bobcats and backhoes. I've also seen some customers of mine where they've got a really unique job. They needed to purchase a tower crane. So we were able to fund that tower crane for them. So it was on site permanently, and it allowed for a reduction in costs on having to get a dog man and a rigger out every couple of weeks and pay those setup costs. The tower crane just sat on the site for the 6 months period. It was utilized a lot more, and it ultimately reduced the rental cost because the client went out and bought it themselves. The other strategy here when we talk about asset finance is we've gone through a period of time recently with instant asset write-off. So when we look at the balance sheet of a construction business, you might have a whole heap of assets on there. So your diggers, your utes, whichever that you've been using, all that plant property and equipment that you've depreciated to nil with your accountant from a taxation strategy. Now, as I mentioned at the start, a lot of those assets are going to have a usable life that's a lot longer than the depreciation schedule. So whether you're trying to fund a gap in working capital, so you might be having some delays on progress payments for a client because of rain, or maybe there's a supplier issue, or potentially you're won a new job and you need to provide a bank guarantee. Most of the banks, myself included, we really want to have our loans for construction companies fully secured. So what that means is we want to be able to take a mortgage over an asset that's got enough equity in it, or receive a significant cash injection through a term deposit before we provide a bank guarantee. With our asset finance product at NAB, with our equipment specialist, we can actually go out to market and get some quotes for you on what a valuation would look like. So we can revalue some assets within your existing fleet that may not have any debt on them. The valuations normally come back with two figures. One is the market value in continued use, and the second is the for sale values. And that's kind of a liquidation value or a secondary market fire sale value. Now, from a risk perspective, because the asset's not brand new, we typically lend from a release of equity perspective on that SFSV value. But you might have an asset, a couple trucks, couple of backhoes that between them, they're probably worth secondary market $500,000 to $600,000. And we're actually able to release you some debt against those assets with a specific charge. So in this situation here, the customer had an asset that they'd bought a long time ago. We ordered a valuation through Pickles, Slattery's, Gray's, any of the auction houses. That cost is paid by the customer, but depending on where the asset's based, it's not an overly onerous cost. It's very different to if you had to value a commercial property or a residential property. The asset itself came back with a market value of $750,000. We had a chat with our credit team and spoke about the differences on where this asset is in the market and how we could look at funding it. We agreed that we would fund the middle, which is about 500,000. So we essentially reimbursed the customer for $300,000, which they paid upfront because there was no funding on it, and we actually gave them an extra 200,000. So they got a lump sum of 500 back on an asset finance loan that was amortized over 5 years. So with a common sense approach, we can look to release equity against your current balance sheet to help you out with whether it's funding things for construction, or maybe it's a purchase of material. Now, what I wanted to sort of just add as a caveat here, if you are going to your lender and continually asking them for 100% funding, there's no problem with us doing that. These assets, like I said before, are income producing. What you need to be aware of is this customer that we helped in this situation was always putting down a deposit, whether it was 10%, whether it was 20%. And by doing that up front and paying that small amount of equity, paying cash into it, it allowed them in a 3 years time for us to go, well, this asset itself has no debt because you paid it down so quickly, or we've revalued it and that equity position that they've already paid up front, plus the repayments they're paid each month, has allowed them to build equity in the asset. If you're in a position where you fund the whole amount, the likelihood of you being able to exercise this strategy is going to be a little bit difficult, because these assets, like I mentioned, they aren't appreciating. They get used, they get dinged up every day on the job site. So it's really important to think about that up front when you're funding these assets.
Yeah, it's an interesting sort of cash flow game that we're playing here, Gus, isn't it, mate? It's,
100%.
Particularly with building construction, because the thing we will say in the cliche phrase is cash is king all the time, but it is very true. And cash flow, above all, is the thing we want to preserve, particularly in construction companies. And we've got these very real assets that have real equity in them. Mm-hmm. And we've got the likes of yourself with NAB that actually have products that are not the sort of bog standard, right? Not the bog standard 5 years, pay it, amortize it perfectly across 12 months, a year, and off we go. That's a really important point on the equity position, though, because the ATO's depreciation will clearly run down faster than what the actual value of the asset depreciates a lot of the time. So that's an important thing. And I will say the balloon thing is something to definitely think about, knowing that you can refinance balloons. For those on the call, it's one of those things that we want to preserve cash in. Equipment finance, the key caveat, which you've said a few times, is that it has to be income producing, right? There's no point using these products for something that's not really going to be for the business, right? So it has to be a core business asset that's going to be used.
Just while we're wrapping up there, I know we do a bit of that reval activity when we're looking at balance sheet position for various licensing regimes like QBCC. Traditional approach, as you say, the ATO is to depreciate to zero. We want to bring them back onto the balance sheet so that we can put forward a pretty strong net tangible asset position.
Yeah.
So we do a
liquidity game as well.
Yeah, that's right. That's for similar kind of rationale. The other thing is, Josh, just quickly, because we're running good on time here, but just really quickly, the idea of how we approach this from a structuring perspective, and maybe even the idea, if you are going to start to build some of these assets into the business, maybe doing that in a separate entity.
One of the most successful things we're seeing doing is particularly builders who have struggled with having to dry or wet hire equipment and not necessarily having access to it, even though you might not need it every day of the week. But when you do have the piece of equipment, it's very helpful to obviously mitigate and sort of manage risk, and also opportunity. We tend to put these assets into their own sort of business structure outside the construction company for a number of reasons, obviously to make sure that we're managing risk with the building companies and your assets. But it's also a way to potentially add a diversified income stream as well, where you do not need to use the equipment all the time yourself. You might dry hire it to someone else. So that's
very common structure. We've got no problem with that, Josh. Typically, we would use the income from the trading business, tie that in as a guarantee. We see it plenty of times where that asset ownership entity might actually be renting it back to the trading business as an intercompany income and expense line item.
Yeah.
Very, very common. And look, yeah, the same with that on hiring to others.
Yeah.
We also have an option when there is on hire, we have different security charges that we take. So sometimes if you are doing that as a secondary line of business, we do need a right of entry, which is an access to the site where the assets are deployed. But that's the reason why you want to make that relationship call to the boys at Xact and, you know, myself at NAB, or maybe your incumbent business banker, is get them on board with that conversation that we're thinking about all of the options up front. Because early engagement, pretty much with whatever you're doing when it comes to your business, is always critical.
Yeah. 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 So it starts always with the business case, you know, like what are the commercial opportunities here around not having to hire gear or whatever the case might be, that we can build out that commercial argument, and then we can look at how we can bring a funding product into the mix. And as we've heard today from Gus, you know, there's some really interesting options on offer these days. If you want to just stop sharing,
Yep.
Gus, I'll just share mine. So just if you want to, guys, drop any questions in. We haven't had any, so I think it's been a morning of just absorbing the information, and I guess just trying to you know, everyone sort of fill the gaps, their knowledge gaps in terms of their understanding of this space. As far as our other content that we offer on these sessions, if you want to, we've just relaunched our website. There's a resources page. This webinar and all the other webinars and articles and tools and things that we produce, they all end up on this resource and insights page. You can sort by topic area. You can sort by category as well. So you might just be looking for our ebooks or our webinars, and you can sort by the format. So I recommend that to you. The other thing I wanted to mention just quickly is our next masterclass webinar is the Xact CFO Guide to Building a High Quality Pipeline. We all want a high quality pipeline. And there's a lot of, I guess, advice and theories and all that sort of stuff in play in that sales and marketing end of town. We're going to come at this from a really rigorous, robust CFO driven perspective about how to build not just a good pipeline, but an actual sales function that doesn't rely on you having to drive the sales all the time. And so how do we do that? And how do we filter for good quality opportunities as well? So that's our next masterclass. We'll be sending emails out about that. All right, I think we're pretty much done. 10:33. Any sort of final things you guys wanted to mention before we check out here?
I'm good.
You're all good?
Are you going to run the poll, Phil?
Oh, yes. How about I run the poll? That's actually quite important to do. So I'll just drop that on now. Here it is. Okay. As I mentioned at the beginning, if you wanted to do a more one-on-one session with either anyone in our team at Xact, so that I've got the different services we offer there, bookkeeping, CFO, tax and structuring, or with NAB, then just hit yes to one of those responses there, and we'll get back in touch with you to set up a time to have a chat. It might be you've got a very specific, narrow question, and we're happy just to deal with that. You might want to find out more about our services, whatever the case might be. We can't really answer the specific questions on these webinars, so it's a good opportunity just to get that next layer of detail that relates to you. Okay. I think that's it, guys. Thanks everyone for coming along. Again, we know everyone's busy, so it's good that you've taken time out to improve your knowledge bank. Thank you very much, Josh, for your insights today. As always, really understand this space very well, so we really benefit from your knowledge. And Augustine, thank you, mate, at the last minute jumping in there on Mo's behalf and to present some options there from NAB. We enjoy the relationship with you guys. You're doing some good stuff in the industry, so good to have you along.
Thank you very much.
All right, thanks everybody, and we'll see you for the Sales Masterclass. Talk to you soon, guys.
See you guys. Bye.